Hey, Brian, your mortgage insider here. We have some great news this week. Inflation is slowing down. There's still quite a bit of inflation out there, but less inflation is great for the markets. If you haven't seen the stock market, it has gone up significantly in the last week. First, consumer price index came out last Thursday. Producer price index just came out today. Producer price index is more of like the wholesale side of things, where all the goods and services start is where you produce them, right? So if those inflation numbers are coming down, that's definitely a sign that future consumer price index could continue to fall. So on that note, I want to show a chart. When will inflation peak? So what this takes a look at is, let's just take October of 2021. Now, the report that came out last week, CPI, Consumer Price Index, this is the core. This strips out food and energy cost. This is the main core inflation, is what the Fed can actually do something about. So 0.6% increase. This was from September of last year up to October, where it was a high point. And then the 2 months, 3 months after that, it was pretty steady at that 0.5% increase. And then in February, March of last year, had a little dip, and then it accelerated again. Had a little blip in July. Get to October. So October this year, 0.3%. So this is year over year adjustments, right? So that replaces 0.6% increase last year. So we reduced our inflation by 0.3%. So this gives, with today's news on the producer price index and the CPI information, the Federal Reserve has the tools that they need to be able to reduce the level of inflation, or see that their inflation fighting powers have started to pay off, which gives them the green light to slow down their pace of increases. They do plan to increase short-term interest rates again in December. If they can come off of their 75 basis point hikes, that is what the markets are rallying behind. So we're going to take a look at market charts. I go over this from time to time, that the mortgage-backed securities, right here, it shows an increase. The green is good, and the cost on the mortgage-backed security, as the investor has to pay a higher premium on basis points for the cost of the bond, that means that the consumer is collecting a lower rate of interest, or paying a lower rate of interest in this case. Whereas on a 10-year, which we'll look at first, this shows a negative, right? So a drop in interest rates. So we can see from just last week, there's a huge drop last Thursday on November the 10th. Monday, Friday was a holiday, so Monday the 14th, we had a little bit of a down day. Today we're down at the averages. So 50-day moving average. These averages are over time. So if you want to curve the cost of interest, as these start to go below these averages, we're going to reset the average to a lower and lower average over time, which should put us on a trajectory to lower interest rates, hopefully. So one thing I'll note here is back on October the 3rd, September the 30th, right at the end of October, we saw first, a pullback on rates, and then we had employment reports that came out at the beginning of October. We saw rates trending higher until these most recent reports on inflation. Okay, so let's take a look at mortgage-backed securities. Mortgage-backed securities had an incredible day last Thursday. So this green is good here. We had a huge spike, a little bit of a setback on Monday, but today already starting to come back because of the producer price index and some other positive news, and air quotes positive meaning negative news for the markets as far as the future of inflation and cost, and the likelihood of a recession, which is a negative thing for the economy overall. But we're seeing that mortgage-backed securities are the beneficiary. So if we go back to that same time period I pointed out a minute ago, into September, we saw the into September reports in mortgage-backed securities started to drop. So I have something that'll help just bring this all together for the novice investor or anybody just interested in what's going on with rates. How can I track it? So this gives a 35-year chart of the 30-year mortgage rates, according to Freddie Mac, versus the 10-year Treasury yield. Okay, so the yield spread between the two. So there's some points on here back in the 90s. They were a similar distance between each other. So if you see, they're not a perfect, but they definitely trend in the same directions. So when 10-year treasuries and mortgage rates are going up, they tend to follow themselves. It's around a 300 basis point spread. So when you're looking at our chart, looking at the 10-year treasury, say, there's about an average of 300 basis points, or 3% higher on the cost to mortgages versus the 10-year treasury. That trends pretty well. Let's say 3.79% today on the 10-year treasury. If you look at mortgages, they are trending less than 7%. They've come off those highs. We talked about the highs being, in middle October, and then again early November. We saw rates peaking at around 7%, a little bit over that, depending on credit scores. Now we're seeing a pullback. So little knowledge for the consumer out there to keep an eye on things for yourself. Love that you tune into these videos. Subscribe to the YouTube page here, and let's stay in touch. Have a great week.